It is Sunday night, and your phone buzzes with an alert that makes you exhale slowly. Dow Jones futures are suddenly down 340 points, and you are left staring at the screen wondering what you missed while you were grilling burgers. The numbers are not just red ink on a chart. They are the knot in your stomach that appears every time you check your 401k balance. You thought we were finally out of the woods. Inflation was cooling, the job market was steady, and the Fed was supposed to be your friend again this year. So why is the market acting like someone just yelled fire in a crowded theater? Let us look at the hard numbers from Thursday alone. The Dow shed 555 points. Apple and Amazon each dropped about 3%. Existing home sales posted their largest monthly decline in nearly 4 years, plunging more than 8%. That is not a gentle correction. That is a thud. Here is a disconnect that should bother you. The economy is not collapsing. Companies are still hiring, and wages are still growing. But the market is no longer trading on what is happening today. It is trading on what investors fear will happen tomorrow. And right now, the fear is that the Federal Reserve is not going to cut rates as aggressively as everyone hoped. Remember when we were talking about 6 rate cuts in 2026? Now the futures market has slashed that expectation to just 2, with the first cut pushed all the way to June. That is a massive shift in sentiment, and it is wreaking havoc on the stocks that soared when money was free. But here's where the story gets more personal for everyday Americans. The housing market is freezing up again because mortgage rates are stuck near 7%. If you are trying to buy your first home or upgrade for a growing family, you are feeling this pain directly. The National Association of Realtors reported that sales fell in every single region of the country, not just the expensive coasts. This is Main Street bleeding into Wall Street. Then there's a quiet panic happening in the technology sector. Cisco disappointed investors this week not because they sold fewer Reuters, but because their profit margins are getting squeezed by the very AI boom they are supposed to benefit from. Think about that irony. The technology that was supposed to save the market is now raising costs and compressing margins. So what do you actually do when the headlines scream volatility and your retirement savings feel like a roller coaster without brakes? The honest answer is that you resist the urge to react. This is not 2008. The banking system is stable, corporate balance sheets are decent, and we are not facing a systemic collapse. What we are facing is a recalibration. The market spent the last 18 months celebrating the end of inflation. Now it must wait for the reality to catch up to the optimism. Friday morning brings a consumer price index report, and everyone will be holding their breath again. But here's a question worth asking yourself. Will one inflation print, hot or cold, actually change your personal financial goals for the next 10 years? The answer is no. Maybe the real story here is not about the Federal Reserve or tech stocks or even housing data. Maybe it is about how we are being trained to treat every market twitch like an emergency that requires immediate action. The Dow will go up again. It always does. But the peace of mind you lose by checking your portfolio every hour and doom-scrolling financial news is much harder to recover. Tonight, futures are down. Tomorrow, the headlines will scream. But the market has survived tariffs, pandemics, wars, and everything else we have thrown at it. It will survive this Friday too. The question is whether you will let the noise convince you that the game has changed when it really has not.